Before we begin, please note that I am not a licensed financial advisor or insurance professional. The information provided in this video is for educational and informational purposes only and should not be considered financial or legal advice. Insurance policies are complex, and your individual needs will vary. Always consult with a qualified and licensed professional before making any decisions about your insurance coverage. You are almost certainly overpaying for your car insurance. I'm not talking about $10 or $20 a month. I'm talking about hundreds, maybe even over $1,000 every single year, that you are lighting on fire and handing over to a massive corporation for absolutely no reason. A buddy of mine, let's call him David, was paying $210 a month for his Ford F-150. He's a safe driver, clean record, and he thought, well, it's a truck, it's just expensive. He'd been with the same company since he was a teenager. Last month, after a single 20-minute phone call using just one of the secrets I'm about to share with you, his bill is now $105 a month for the exact same coverage. Bodily injury, property damage, collision, comprehensive, all identical. He cut his bill in half. That's $1,260 back in his pocket this year. That's a vacation. That's an emergency fund. That's a huge chunk of a credit card paid off. And by the end of this video, you will have the exact 7-step playbook to do the same thing. Let's be real. Car insurance feels like a scam. It's this mandatory thing you have to buy. The price is determined by some secret black box algorithm you're not allowed to see, and it seems to go up every 6 months for no reason at all. Did you get in an accident? No. Did you get a ticket? No. So why are you paying more? The entire industry is designed to be confusing. It's built on the idea that you're too busy, too intimidated, or too complacent to question the bill they send you. They count on you to just sigh, pay it, and move on with your life. They profit from your inaction. Well, today that ends. Today we pull back the curtain. I am going to demystify this entire process for you. I'm going to give you 7 specific, field-tested, actionable strategies that you can use starting today to dramatically lower your car insurance bill. This isn't vague advice like drive safer. This is the inside baseball. These are the levers you can actually pull, the questions you can ask, and the knowledge you can use to force these companies to compete for your business and give you the fair price you deserve. I've spent years digging into the rate filings, talking to former agents, and personally testing these methods to see what actually moves the needle. And what I found is that the power is not with them. It's with you. You just need to know how to use it. So let's get right into it. The very first, the most important, the absolute non-negotiable strategy to getting cheaper car insurance is the one that 80% of people never do. And that is to shop around aggressively and consistently. I know it sounds so simple, so obvious. But you would be shocked at how few people actually do this. They think, I've been with my company for 10 years, I get a loyalty discount. Let me tell you a secret the insurance industry doesn't want you to know. The loyalty discount is one of the biggest myths in personal finance. In most cases, loyalty doesn't get you a discount, it gets you a penalty. It's called a price optimization strategy, or more bluntly, a loyalty tax. Here's how it works. Insurance companies have incredibly sophisticated data models. They know, based on your history, your demographics, and your behavior, exactly how likely you are to switch providers. If their data says you're a sticky customer, someone who never shops around, they know they can slowly, incrementally, raise your rates every renewal period and you'll probably just pay it. A 4% increase here, a 6% increase there, you might not even notice it. But after 5 or 10 years, you're paying significantly more than a brand new customer would pay for the exact same policy. They are penalizing you for your loyalty because they're betting you won't go through the hassle of leaving. That's their business model. Your complacency is their profit margin. So how do you fight back? You have to prove their data wrong. You have to become a shopper. This is the single biggest lever you can pull to save money, and it should be your top priority. I recommend you shop for new insurance quotes at least once a year, every single year, about 30 days before your current policy is set to renew. You should also shop anytime you have a major life event. Getting married? Shop for quotes. Moving to a new zip code? Shop for quotes. Buying a new car? Shop for quotes before you even sign the papers. Your credit score improves significantly? That's a huge one. Shop for quotes. Each of these events can dramatically change your risk profile and therefore your rate. The company that was cheapest for you last year as a single renter in the city might be the most expensive for you this year as a married homeowner in the suburbs. The only way to know is to shop. Okay, so what does shopping actually look like? You have three main options. First, you can go direct. This means going to the websites of individual companies like Geico, Progressive, or Liberty Mutual and filling out their quote forms one by one. This can be time-consuming, but it ensures you're getting a direct quote without any middleman. Second, you can use a captive agent. This is someone who works for a single company like State Farm or Allstate. They can be helpful, but remember, they can only sell you products from their one company, so you're not getting a full market comparison. The third, and in my opinion the most effective option for most people, is to work with an independent insurance agent or broker. Unlike a captive agent, an independent agent works with dozens of different insurance companies. Their job is to take your information once and then go out and shop the market for you, bringing back the best options from multiple carriers. This saves you an incredible amount of time and effort. They can compare quotes from the big national brands and also from smaller, regional companies you may have never even heard of that might offer fantastic rates in your area. They get paid a commission by the insurance company they place you with, so it costs you nothing to use their service. A good independent agent is worth their weight in gold. You can find them by searching online for independent insurance agent near me. When you start this process, make sure you are comparing apples to apples. This is critical. Don't just look at the final price. You need to have your current policy's declarations page in front of you. This is the summary of your coverage. You want to make sure every quote you get has the exact same liability limits, for example 100/300/100, which means $100,000 for bodily injury per person, $300,000 per accident, and $100,000 for property damage. You also want to match your collision and comprehensive deductibles. A quote might look incredibly cheap, but then you realize it's because they've set your deductible at $2,000 instead of the $500 you have now, or they've slashed your liability limits to the state minimum, which is a massive financial risk. Get quotes for the exact same coverage first. Once you find the cheapest company for that identical coverage, then you can start playing with the deductibles and coverage levels to save even more money, which we'll talk about later in this video. The simple act of shopping sends a powerful signal to the market. You are an active, informed consumer, not a passive piggy bank. It forces companies to compete for your business, and you will be absolutely stunned by the difference in price. It is not uncommon to see a 50%, 100%, or even 200% difference in quotes between companies for the exact same driver and the exact same coverage. There is no single best or cheapest insurance company. There is only the company that is cheapest for you with your specific car, your driving history, and your zip code right now. And that will change. So you have to make shopping a regular financial habit, like checking your bank account or reviewing your budget. It's a 30-minute task once a year that can easily save you over $500. There is no other financial move you can make that has a higher return on your time. So that is your foundation. That is step one. Before you do anything else, you must commit to becoming a regular shopper. But this is just the beginning. Once you start getting those quotes, how do you make sure you're squeezing every last dollar of savings out of them? That's where our next strategy comes in, and it involves understanding the secret discounts that most agents will never tell you about unless you ask for them by name. Think of your car insurance policy like a restaurant menu. Most people walk in and order one of the main entrees at the price listed. They pay it and they leave. But what the savviest customers know is that there's a secret off-menu list of specials and combinations. These aren't advertised on the big board because the restaurant, or in this case the insurance company, makes more money when you don't ask for them. Your job is to walk up to that counter, look the agent in the eye, and start ordering from the secret menu. Let's start with the discounts that are all about you, the driver. The first one is the defensive driving course discount. Now you might hear defensive driving and think of a boring Saturday in a stuffy classroom, and you're not entirely wrong. But here's the reality. A one-time online course that costs maybe $25 and takes a few hours can net you a discount of 5 to 10% on your insurance for 3 full years. Let's do the math. If your premium is $2,000 a year, a 10% discount is $200. Over 3 years, that's $600 in savings for a $25 investment and an afternoon on your couch. Why do they offer this? Because statistics show that people who take these courses are less likely to get into accidents. You are actively making yourself a lower risk, and they have to reward you for it. Just make sure you ask your insurer which specific courses they approve before you sign up. Next up, for those of you in school or with kids in school, the Good Student Discount. This is a big one, and it's often overlooked. If you or a driver on your policy is a full-time high school or college student and maintains at least AB average, or a 3.0 GPA, You can often get a discount of anywhere from 10 to 25%. To an insurer, a good student is a responsible person. They're less likely to be reckless, less likely to be out late at night, and more likely to be a cautious driver. It's a simple correlation, but it saves you real money. All you typically need to do is send in a copy of a report card or transcript once or twice a year. It's one of the single biggest discounts a young driver can get. But here's a real secret menu item that most people have no idea exists. Affinity group discounts. Insurance companies make deals with large organizations to offer special rates to their members. Think about every group you belong to. Are you a member of an alumni association from your college? There's probably a discount for that. Are you a veteran or active duty military? There are huge discounts for that. Are you a member of a specific credit union, a professional organization for teachers, engineers, nurses, or government workers? Check, check, and check. Companies like Geico, for example, were originally founded to serve government employees. That's what the G in Geico stands for. They have hundreds of these partnerships. These discounts aren't usually advertised during a generic online quote process. You have to ask. Make a list of every organization you're a part of and ask your agent, do you have an affinity discount for members of the American Nurses Association? Or, what about the University of Florida Alumni Association? You'll be shocked at what you find. Okay, so we've covered discounts about you. Now let's talk about the secret menu for your CAR. Every car comes with standard safety features these days, like airbags and anti-lock brakes, and those are already factored into your base rate. But what about the extras? Does your car have an anti-theft system? This is a big one. Insurers separate these into two categories: passive and active. A passive device is something that arms automatically, like an engine immobilizer that's built into your car key. An active device is something you have to turn on, like a steering wheel lock or an alarm you have to arm. Passive devices get you a bigger discount because there's no chance of human error. You can't forget to turn it on. Even something as simple and cheap as VIN etching, where you have the vehicle identification number etched into your windows, can sometimes get you a small discount because it makes your car harder for thieves to sell. Again, they won't just give you this discount. You have to tell them you have these features. Then there's the low mileage discount. With so many people working from home, this has become one of the most powerful and underutilized ways to save money. Most insurance rates are calculated assuming you drive a national average of around 12,000 to 15,000 miles per year. If you drive significantly less than that, say under 7,500 miles, you are a much lower risk. You're simply on the road less, so your chances of getting into an accident are lower. If you're a remote worker, a retiree, or just someone who lives close to work, you need to call your insurance company and tell them. They may ask for proof, like an odometer reading from your last oil change, but the savings can be substantial, sometimes as high as 20%. This isn't a small adjustment. It fundamentally changes how they classify you as a driver. Finally, let's talk about the discounts on the policy itself, the way you pay and manage your account. This is where we find the most famous discount of all, but one that comes with a hidden trap: bundling. You've seen the commercials a million times. Bundle your home and auto insurance and save a ton of money. And very often that's true. The discount for having multiple policies with one company can be one of the biggest they offer, often up to 25%. The logic is simple. They want more of your business, and it's cheaper for them to manage one customer with two policies than two separate customers. But here is the dirty little secret the insurance giants don't want you to know. Sometimes bundling is a trick. It gives you the feeling of a great deal, but you might actually be overpaying. A 25% discount on an overpriced auto policy, bundled with an overpriced home policy, can still be more expensive than getting the two best priced policies from two separate companies. The only way to know for sure is to do the work. When you're shopping around, you have to get 3 sets of quotes. Quote A, your auto insurance alone. Quote B, your home or renter's insurance alone. And quote C, the bundled price for both from the same company. You might find that company X has an unbeatable auto rate, while company Y has an incredible home rate, and even without a bundling discount, the two separate policies combined are cheaper than the bundle from either company. The convenience of one bill is not worth hundreds of dollars a year. 2 other easy policy discounts: the pay-in-full discount and the paperless discount. Insurance companies love it when you pay your entire 6-month or 12-month premium upfront. It saves them administrative costs of processing monthly payments, and it guarantees they have your business for that entire term. For that, they'll often give you a 5 to 10% discount. If you have the cash available, it's basically free money. Similarly, signing up for autopay and paperless billing saves them money on postage and processing. It's a tiny discount, maybe 3 to 5%, but why wouldn't you take it? It takes 10 seconds to click a button online, and it puts money back in your pocket. See how this works? It's not about one single discount. It's about stacking them. The defensive driving discount, plus the low mileage discount, plus the affinity group discount, plus the pay in full discount. Suddenly, these little 5 and 10% savings start to add up to a massive 30, 40, or even 50% reduction in your premium. You are building your own discount. You've gone from ordering the standard combo meal to creating a custom platter from the secret menu that costs half as much. But even with all these discounts, there's one single factor that can overpower all of them combined: the exact car you choose to drive. And the reason why will shock you. It has almost nothing to do with how much the car is worth, and everything to do with a secret set of data that your insurance company is looking at that you probably aren't. It's a concept insurance companies call loss history. But it's not your loss history. It's the car's. Every single make, model, and year of a vehicle has its own secret resume. A detailed report card that insurers study obsessively. This report card is built on billions of miles of real-world driving data and millions of insurance claims. It tells them 3 things with terrifying accuracy: how likely that car is to be stolen, how much it costs to fix when it gets dinged, and this is the big one, how likely the typical driver of that car is to crash it. Let's break that down, because understanding this is the key to unlocking massive savings. First, let's talk about theft. You would think a $50,000 brand new Lexus would be a prime target for thieves, and therefore expensive to insure. And you'd be right. But what if I told you that a 12-year-old Honda Accord could, in some areas, cost even more to insure against theft? It makes no sense, right? The car is worth maybe $8,000. Why would the insurance be so high? Because for decades, the Honda Accord and Honda Civic have been at the top of the most stolen vehicles in America list. They're everywhere. That means there's a massive black market for their parts, catalytic converters, airbags, doors, you name it. A thief can strip an old Accord and sell the parts for more than the car is worth whole. The insurance company knows this. They know that your specific 2012 Accord, parked on a city street, has a statistically higher chance of disappearing overnight than a brand new, less common vehicle with a more advanced anti-theft system. So while the owner of the new car is paying for its high replacement value, you're paying for your car's criminal popularity. Before you buy any car, especially a popular used model, do a quick 5-second search. Top stolen cars in your state. The results might completely change your mind about that great deal you found. But let's say theft isn't a huge issue where you live. The second piece of that secret data is even more important: the cost of repair. This is where so many people get trapped. They buy a beautiful 5-year-old used luxury car, a BMW, a Mercedes, an Audi, for the same price as a brand new Toyota Camry. They think they're getting a bargain, and on the day they buy it, they are. But the insurance company isn't pricing the car based on what you paid for it. They're pricing it based on what it will cost to fix it. And a 5-year-old BMW does not have 5-year-old BMW repair costs. It has brand new BMW repair costs. The parts are still priced as if they're going on a $70,000 car. The headlight assembly, with its fancy LEDs and auto-leveling motors, that could be $2,000. The side mirror with the integrated turn signal and blind spot sensor? $1,000. That simple plastic bumper cover? It's not so simple anymore. It's loaded with parking sensors, cameras, and radar for the adaptive cruise control. A minor parking lot bump that would cost $500 to fix on a basic Ford Focus can easily become a $5,000 claim on a modern luxury or even a high-trim level standard car. The insurance company knows this. They have databases that list the cost of every single part, from a lug nut to a transmission. They know that the labor rate at a certified German auto body shop is significantly higher than at the shop that works on domestic trucks. So when they see you want to insure that used Audi A4, they don't see a $25,000 car. They see a car with the potential for a $10,000 repair bill from a single fender bender. Meanwhile, the person insuring the brand new Toyota Camry might pay less, because Toyota parts are mass-produced, readily available, and cheaper. The car is designed to be repaired affordably. This is a hidden tax on complexity. A car loaded with tech and gizmos is a car loaded with expensive future repair bills. And your insurance premium will reflect that from day one. Now, for the third and most controversial piece of data, the one that feels deeply unfair. The insurance company analyzes the collective behavior of every single person who drives your exact model of car. They aren't just insuring your car. They're insuring the stereotype of the person who drives it. Think about it. Who typically buys a Subaru Outback? The data might show it's families, people who enjoy the outdoors, and have a reputation for safe, cautious driving. The collective loss history for Subaru Outbacks is likely filled with very few at-fault accidents, and the ones that do happen are low-speed incidents. Now, who typically buys a Dodge Charger or a Ford Mustang? Even if you are the most responsible 45-year-old driver with a spotless record, when you buy that Mustang, you are being statistically lumped in with every 19-year-old who just got their license and wants to do burnouts in the high school parking lot. The data pool for that car is filled with more speeding tickets, more reckless driving claims, and more high-speed total loss accidents. The insurance company isn't judging you personally. They can't. They're playing a game of averages. They look at the Mustang and their algorithm says, "Warning, this model is frequently involved in expensive, at-fault collisions. Increase the premium." It's a driver profile penalty. You are, in a very real sense, paying for the sins of other drivers who happen to like the same car you do. This is why a practical, boring sedan or a minivan is almost always cheaper to insure than a sporty coupe or a massive lifted truck, even if they all cost the exact same amount of money to purchase. One is associated with risk, the other with responsibility. So, how do you use this insider knowledge to your advantage? It's simple, but it requires a shift in how you shop for a car. Most people find a car they love, negotiate the price, buy it, and then call their insurance agent only to be shocked by the premium. You need to do it in reverse. Before you even step foot on a dealership lot, before you even get excited about a car, you need to become your own insurance investigator. Make a list of 5 or 6 cars that you're interested in. Then, go to your current insurance company's website or any major insurance comparison site. Get a quote for your current policy but swap out the vehicle. Run a quote for the Honda CR-V. Then run a new one for the Ford Escape. Run one for the Mazda CX-5. Run one for that used BMW X3 you've been eyeing. You will be stunned by the difference. You might find that 2 SUVs that are nearly identical in price, size, and features have a $400 a year difference in their insurance premiums. That's thousands of dollars over the life of the car. Suddenly, the cheaper car is actually the more expensive one. You are now making a decision not just on the sticker price, but on the total cost of ownership. You're using the insurance company's own secret data against them to find the true bargain. The best car for your wallet isn't just the one you get a good deal on. It's the one that insurers have secretly labeled as safe, cheap to fix, and driven by boringly responsible people. So you've done your homework. You've picked the perfect car. It's a theft-proof, easy-to-repair, safety-conscious vehicle. Your quote should be rock bottom, right? Not necessarily, because there's another factor, one that has nothing to do with you or your car, that can add hundreds of dollars to your premium overnight. And it all comes down to 5 little numbers. Your zip code. The story of why 2 people living just 1 street apart can pay wildly different rates is not what you think. It's a practice called territorial rating, and it's one of the most powerful and controversial tools in an insurer's arsenal. To them, your zip code isn't just a location. It's a crystal ball. It's a proxy for predicting the future. And they've spent billions of dollars perfecting this prediction model. Imagine 2 people. Let's call them Alex and Ben. They live in the same city, just a few miles apart. Alex lives in a quiet suburban neighborhood, zip code 11234. Ben lives closer to the bustling city center, zip code 11201. They are the same age, drive the exact same 2022 Honda Accord, have spotless driving records, and even have the same credit score. They are, for all intents and purposes, identical twins to an insurance company. Except for one thing. Ben pays 45% more for his car insurance than Alex. $400, $500, maybe even $1,000 more per year for the same coverage on the same car with the same driver. Why? Because when the insurance company looks at Ben's zip code, 11201, their algorithm sees red flags. First, it sees traffic density. Ben's neighborhood is packed. More cars per square mile, more complex intersections, more frantic delivery trucks, and more stressed-out commuters. The sheer probability of an accident, a fender bender, a sideswipe, a rear-end collision, is exponentially higher. The insurer's data, stretching back decades, shows that they pay out more claims for accidents in 11201 than in 11234. It's not personal, it's pure statistics. Second, the algorithm sees crime rates. It pulls in data from local police reports and national databases. It knows exactly how many cars are stolen, broken into, or vandalized in Ben's zip code each year compared to Alex's. If Ben's area has a higher rate of auto theft, the risk of the insurer having to pay out a $25,000 claim for a stolen Honda Accord goes way up. That risk gets priced directly into Ben's premium. Third, it sees weather patterns. This is a big one. Some zip codes are in Hail Alley in the Midwest, where golf ball-sized hail can cause thousands in damage to hundreds of cars in a single afternoon. Others are in coastal regions prone to flooding during hurricanes. Even highly localized microclimates can have an effect. If Ben's zip code is in a low-lying area known for flash floods, his risk profile is higher than Alex's on the hill. Fourth, and this is a sneaky one most people don't know about, is litigation risk. In some zip codes, people are simply more likely to hire a lawyer and sue after an accident, even a minor one. This drives up the cost of bodily injury claims astronomically. A simple whiplash claim that might settle for a few $1,000s in Alex's zip code could spiral into a $50,000 legal battle in Ben's. Insurers track this data obsessively, and they will charge residents of sue-happy zip codes a hefty premium to cover that potential legal exposure. And finally, it comes down to repair costs. The cost of labor and parts isn't uniform. A body shop in a high-rent, downtown area like Ben's has higher overhead than a shop in Alex's suburb. Those higher repair costs are passed on to the insurance company, which then passes them right back to the customers in that zip code. So, when Ben gets his quote, he's not just paying for his own driving habits. He's paying for the driving habits of his thousands of neighbors. He's paying for the local crime rate, the local weather, the local legal climate, and even the local mechanic's rent. He is, in effect, subsidizing the risk of his entire community. Now you might be thinking, that's not fair. And you're not alone. Critics call this a form of modern-day redlining, arguing that using a zip code as a primary rating factor disproportionately penalizes people in lower-income and minority communities who may not be able to afford to live in the safer, more expensive zip codes. They are being judged not by the content of their driving record, but by the location of their address. Some states are listening. California, for example, has passed laws that force insurers to prioritize a driver's personal record, their miles driven, and their years of experience above their zip code. Michigan enacted major reforms for the same reason, but for the vast majority of the country, your zip code remains a kingmaker or a kingbreaker in the world of insurance rates. So, this brings us to our very first and perhaps most impactful strategy for lowering your car insurance. And it's a big one. Strategy number 1, master your location factors. Now I know what you're thinking. Are you telling me I have to sell my house and move to a different zip code just to save a few $100 on car insurance? No, of course not. For 99% of people, that's completely unrealistic. But knowledge is power. And understanding how much your location is costing you can inform future decisions. If you're already planning a move across town or to a new city, this should be a critical part of your research. Before you sign a lease or make an offer on a house, take 15 minutes and run some ghost quotes. Go to a major insurer's website, plug in your details, but use the zip code of the neighborhood you're considering. Then try another one a few miles away. The difference might shock you. Could be $100 a month. That's $1,200 a year, which is absolutely a factor worth considering when choosing where to live. But for everyone who isn't moving, there are still powerful moves you can make right where you are. It starts with where your car sleeps at night. When you get a quote, the insurance company will ask you where the vehicle is garaged. This is a critical question. Parking on the street is the highest risk. It's exposed to sideswipes from passing traffic, theft, vandalism, and hail. A driveway is a little better. It's off the main road but still exposed. The gold standard is a locked private garage. A car in a garage is invisible to thieves. It's protected from hail, falling tree limbs, and hit-and-run drivers. From a risk perspective, a garaged car is in a completely different universe than one parked on the street. This difference is reflected in your premium, specifically in your comprehensive and collision coverage costs. If you have a garage but you're using it to store old furniture and junk while your $20,000 car sits outside, you are literally throwing money away. Clean out that garage. It's not just a storage space. It's an insurance cutting machine. If you've been telling your insurer you park on the street, but recently cleaned out your garage, call them immediately. That one phone call could save you 5 to 15% on your coverage. The second part of mastering your location is your commute. How you use your car is just as important as where you keep it. Insurers typically classify your driving habits into 3 categories: pleasure use, commuting to work or school, and business use. Commuting is generally more expensive than pleasure use because it means you're on the road during the busiest, most accident-prone times of day. Rush hour. The pandemic changed the game for millions of people. If you used to commute 20 miles to the office every day but now you work from home, you need to tell your insurer. Your risk profile has just plummeted. You've gone from a high-risk commuter to a low-risk pleasure driver overnight. But your insurance company won't know that unless you tell them. They will happily keep charging you that higher commuter rate until you pick up the phone. When you call, be specific. Tell them your estimated annual mileage has dropped from, say, 15,000 miles a year to 5,000. This is a massive change that should trigger a significant discount. Don't just assume they know. You have to be proactive. This is one of the easiest and most common ways people overpay. They change their driving habits but forget to update the company that's charging them based on those old habits. So to recap, strategy number 1, understand that your zip code is the foundation of your rate. If you're moving, use that knowledge to your advantage. But no matter where you live, you can lower your risk and your premium by garaging your car if possible, and most importantly, by ensuring your insurer has your correct, up-to-date mileage and use. Stop paying to be a commuter if you're now working from your kitchen table. Changing your location or how you park can make a huge dent in your bill. But what if you can't? What if you're stuck in a high-cost zip code and you only have street parking? Are you just doomed to pay high rates forever? Absolutely not. Because there's another number, a number completely unrelated to your car or your driving, that insurers are using to judge you. It has nothing to do with where you live and everything to do with how you live. And for millions of Americans, this one number is secretly adding hundreds of dollars to their bill every single year, and they have no idea. It's not your zip code and it's not your VIN. It's a 3-digit number you probably think is only for getting a loan. Your credit score. I know what you're thinking. My credit score? What on earth does my Visa bill have to do with my driving? I could have an 850 FICO score and still drive like a maniac, or have a 500 score and be the safest driver on the road. And logically, you are 100% correct. But we're not operating in the world of logic. We're operating in the world of actuarial tables, risk pools, and statistical probability. And in that world, insurance companies have found a correlation that is so strong, so predictive, that they are willing to bet billions of dollars on it every single year. Here's the secret they don't advertise. They believe that how you manage your money is a powerful predictor of how you'll manage your car. The data they claim shows that people with lower credit scores file more claims. Not just more expensive claims, but more claims in general. They are statistically more likely to get into accidents, more likely to have their car stolen, and more likely to file a claim for a minor fender bender that someone with better credit might just pay for out of pocket. Is it fair? Absolutely not. It's a system that penalizes people for past financial struggles, a job loss, a medical emergency, or a divorce, things that have nothing to do with their ability to check a blind spot. It's a hidden tax on life's hardships. But is it real? You better believe it. The difference in premiums is staggering. We're not talking about a few dollars a month. A study by Consumer Reports found that a driver with poor credit could pay, on average, over $2,000 more per year than an identical driver with excellent credit. In some states, it's even more extreme. A driver with poor credit in Michigan might pay over $5,000 more annually than their neighbor with a great score. You could be a perfect driver with a spotless record, but if your credit is in the gutter, you'll often pay more than a driver with a recent DUI and excellent credit. Let that sink in. You are being judged not on your driving but on your debt. Now, before you panic, there are a few exceptions. A handful of states have recognized how unfair this is and have banned or severely restricted the use of credit scores in setting auto insurance rates. As of today, those states are California, Hawaii, and Massachusetts. Michigan also has significant restrictions. If you live in one of those states, you can breathe a little easier on this specific point. But for the other 46 states, this is one of the single biggest levers affecting your premium. It's the ghost in the machine of your insurance bill. So how do we fight back? How do we take control of this number and stop it from silently draining our bank accounts? It's a two-step process. Know your score and then build your score. First, you need to know where you stand. You are legally entitled to a free copy of your credit report from all 3 major bureaus, Equifax, Experian, and TransUnion, once a year. The official site for this is annualcreditreport.com. Don't go to those other sites with free, in the name that try to sign you up for a subscription. Just use the official government-mandated one. There are also great free apps like Credit Karma, or the one from your credit card company that let you monitor your score regularly. Look at it. Understand it. It's not a grade on your self-worth. It's just a number. And any number can be changed. Once you know your score, it's time to improve it. Forget all the complicated advice and credit repair scams. 90% of your score is determined by just a few simple things. If you focus on these, you will see results. Number 1, and this is the absolute king. Pay your bills on time every single time. Your payment history is the single largest factor in your credit score, making up about 35% of it. A single 30-day late payment can crater your score by up to 100 points, and that damage can linger for 7 years. So what's the fix? Automate everything. Set up automatic payments for at least the minimum amount due on every single one of your bills, credit cards, student loans, car payments, everything. Even if you can't pay the full balance, paying the minimum on time is infinitely better than paying the full balance a week late. Make on time your religion. Number 2, lower your credit utilization. This sounds complicated, but it's simple. It's the amount of debt you have compared to your total credit limit. If you have a credit card with a $10,000 limit and a $3,000 balance, your utilization is 30%. This is the second biggest factor in your score. The lower, the better. Your goal should be to keep your overall utilization below 30%, but the real magic happens when you get it under 10%. People with the highest credit scores, the 800+ club, often have a utilization of less than 7%. So focus on paying down those balances. If you can't pay them down quickly, you can try calling your credit card company and asking for a credit limit increase. If they grant it, your utilization percentage instantly drops, even without paying a dime. Number 3, don't close old credit cards. A big part of your score is the average age of your credit accounts. The longer your credit history, the more stable and reliable you appear. When you close an old account, especially your oldest one, you're erasing that history. The 10-year-old card you never use is actually a powerful asset. It's acting as an anchor, boosting the average age of your accounts. So instead of closing it, just use it once every 6 months for a small purchase, a pack of gum, a coffee, and pay it off immediately. This keeps the account active and working for you. Now, it's important to know that insurance companies don't use your regular FICO score. They use something called a credit-based insurance score. It's a proprietary score that uses information from your credit report, but weighs it differently to predict insurance losses. You can't see this score and you can't directly influence it. But here's the key. The same factors that build your FICO score also build your insurance score. Improve your payment history, lower your utilization, and lengthen your credit history, and your insurance score will rise right alongside your FICO score. Think about a woman named Jessica, a 35-year-old nurse, a perfect driver, not a single ticket or accident in her life. But she went through a tough divorce 5 years ago and missed a few credit card payments while getting back on her feet. She just assumed her $600 premium was normal for her 2018 Honda Civic. She had no idea her credit was costing her. She spent 6 months focused. She set up autopay on everything. She aggressively paid down one of her credit cards, getting its utilization from 80% down to 15%. She didn't open any new accounts or close any old ones. Her credit score shot up from 640 to 730. The next time her insurance was up for renewal, she shopped around. The quotes she got back were shocking. Her old company offered to drop her rate to $450. A new company quoted her $320. By focusing on that one 3-digit number for just 6 months, she saved herself almost $300 a year. That's real money. That's a car payment. That's a weekend trip. That's the power of taking control of this hidden factor. Improving your credit isn't just about getting a better mortgage rate anymore. It's about lowering the fundamental costs of living, and car insurance is one of the biggest. It takes time and discipline, but the payoff is massive and it lasts for years. But even if you have a perfect 850 credit score, there's a tiny device, smaller than a deck of cards, that insurers are begging you to put in your car. Some say it's a massive discount. Others say it's a privacy nightmare. The truth is, it's both. And I'm going to show you how to get the discount without giving up your data. Let's pull back the curtain on these little black boxes, these digital tattletales. The technology is called telematics, or usage-based insurance. And it's the biggest double-edged sword in the entire industry. The concept is seductively simple. Prove you're a good driver and we'll give you a massive discount. The insurance company gives you a small device that plugs into your car's OBD2 port. That's the little port under your steering wheel mechanics use. Or they have you download an app on your phone. For the next few months, this little spy silently watches. It tracks your driving habits. Things like hard braking, sudden acceleration, how many miles you drive, and what time of day you drive. If you drive smoothly, during daylight hours, and don't slam on the brakes, their algorithm labels you a safe driver. And just like that, you could see a discount of 10, 20, even 30% on your premium. Progressive Snapshot Program, one of the most famous, claims an average annual savings of $156. For some people, it's over $300. Sounds great, right? A discount for doing what you already do. But here's what they don't put in the flashy commercials. That little device isn't just a friendly coach. It's a data harvesting machine with a direct line to the people who set your insurance rates. And they are collecting way more than just your braking habits. They're tracking your location, every trip to the grocery store, every late-night drive home from a friend's house. They know where you live, where you work, and the exact routes you take. They know if you drive through a neighborhood they consider high risk. They know if you're driving at 2 a.m. because you work the night shift, or because you were out at a bar. They don't know the context, they just see the data point, high-risk driving time. And all of this information is being fed into a complex algorithm that is building a digital profile of you. Think about it. You have to slam on your brakes because someone cuts you off. The device doesn't see the other car. It just sees, hard braking event, -5 points for Gryffindor. You have to accelerate quickly to merge onto a busy highway. The device just sees rapid acceleration, risky behavior. The system is designed to penalize normal, defensive driving in the real world. Worse yet, what happens to all this data? The privacy policies are a labyrinth of legal jargon, but they often give the company the right to use your data for, well, almost anything. Research, marketing, and even sharing it with third parties. Who are these third parties? Data brokers? Law enforcement? Your data, your personal travel history, becomes a commodity to be bought and sold. And here's the kicker they really don't want you to know. It's not just a discount program. For many companies, it can also be a surcharge program. If the little box decides it doesn't like your driving, your rates won't just stay the same. They can actually go up. You could sign up hoping for a discount and end up with a penalty, all because you live in a city with stop-and-go traffic. So you have this privacy vampire in your car, tracking your every move with the power to actually charge you more money. It's a terrible deal. But that 30% discount, it's still sitting there, tantalizingly on the table. So how do we get the money without becoming a character in a dystopian sci-fi novel? How do we beat them at their own game? Here's the playbook. This is how you get the discount and protect your privacy. First, and this is the most important rule, if you have a choice between the physical plug-in device and the smartphone app, always choose the plug-in device. Always. The app is a Trojan horse. It doesn't just track your driving. It has access to everything on your phone. It uses your phone's motion sensors to know when you're in a moving vehicle, even if you're not the one driving. So if you're a passenger in your friend's Uber and the driver is a maniac, the app on your phone can flag you for aggressive driving. If you're on a city bus that's lurching through traffic, your safe driver score can take a hit. The app is always on, always watching. The physical plug-in device only knows what the car is doing, and only when it's plugged in. It's the lesser of two evils, and it's the one we can control. Second, understand the initial monitoring period. Most of these programs don't watch you forever. They have an initial period, usually 90 days or up to one policy term of 6 months, where they gather the data to calculate your discount. After that period, the discount is locked in for the next policy term. This is the window of opportunity. For those 90 days, you are going to be the most perfect, cautious, law-abiding driver on the planet. Imagine your grandma is in the passenger seat, holding a full bowl of hot soup. That's how you're going to drive. No fast starts. Leave huge following distances so you can brake by just easing off the gas. Coast to a stop. Take the corners like you're driving a parade float. For 90 days you play their game. You get the A+ rating. You lock in that beautiful 25 or 30% discount. And now for the crucial step. Once that discount is locked in and applied to your policy, you call them up or check the app and find out if you can return the device. For many programs, including Progressive Snapshot in many states, you can. You unplug that little spy, put it in the prepaid envelope they sent you and mail it back. You keep the discount for the remainder of your policy, and they can no longer track you. You get the reward without the risk. You have to verify this for your specific company and state, but a simple phone call asking, "After my initial period, can I send the device back?" is all it takes. But what if you have 2 cars? This is where you can get really smart. Let's say you have one car you use every day for your commute, and a second car, maybe an older one that you just use for weekend errands. Which car do you think you should enroll in the telematics program? You enroll the weekend car. The one that gets driven maybe 20 miles a week at a leisurely pace to the farmer's market. You put the device in that car, drive it perfectly for the evaluation period, and get a massive discount that often applies to the entire policy, including your primary car that they never get to see. You are giving them a data sample that is completely unrepresentative of your actual driving, and they are rewarding you for it. It's their system. You're just using it to your advantage. So let's recap the strategy. 1. Choose the physical plug-in device, never the app. 2. Identify the initial monitoring period and drive like a saint for those 90 days. 3. Once the discount is locked in, confirm that you can unplug and return the device. 4. If you have multiple cars, install the device on the one that is driven the least and the most carefully. By doing this, you flip the script. You take control of the data they receive, you maximize your discount, and you minimize your privacy invasion. You get the cash, and they get a bunch of useless, misleading data about a car that barely leaves the driveway. But let's be honest, maybe this all sounds like too much work. Maybe you don't want to plug anything into your car or change your driving habits at all. What if I told you there's a way to potentially save even more money, and it doesn't involve any technology? It involves understanding a single number, a 3-digit score that you probably think is only for getting a loan or a credit card. But insurance companies are obsessed with it, and it has a shocking, almost unbelievable impact on the price you pay for car insurance. In some states, a person with a poor score can pay more than double what a person with a good score pays for the exact same coverage on the exact same car. And I'm going to show you how to fix it, because the numbers don't lie. Insurers are giant data companies, and their actuaries have found a direct, statistically significant correlation between how a person manages their financial responsibilities and how likely they are to file a claim. To them, a person who pays their bills on time is also more likely to be a responsible, defensive driver who maintains their vehicle properly. A person who is overextended on credit might be more stressed, more distracted, or more likely to delay critical car repairs. Now you might be thinking, that's not fair. My finances have nothing to do with my driving. And I hear you. Many people feel that way. But whether we agree with the logic or not, this is the system we're operating in. Ignoring it is like willingly paying a massive, unnecessary tax. Understanding it, and learning how to master it, is one of the most powerful money-saving skills you can develop. So what are they actually looking at? They're not looking at your FICO score or your Vantage score directly. Insurance companies use a special proprietary score called a credit-based insurance score. While the exact formula is a secret for each company, it's built from the same raw material. The information in your credit report from Equifax, Experian, and TransUnion. And the factors that influence it are the same ones that influence your regular credit score. This is fantastic news. Why? Because it means you don't have to learn a whole new system. By improving your general credit health, you are directly improving your insurance score and lowering your premiums. It's a 2-for-1 deal. Let's break down exactly how to do this. This isn't just vague advice like, pay your bills on time. I'm going to give you a precise, step-by-step battle plan to optimize your credit profile specifically for the purpose of slashing your car insurance bill. Step 1 is the foundation for everything else. You must get a copy of your full credit report from all 3 bureaus. Not just the score, the entire report. Do not go to a website that promises a free credit score and asks for your credit card. The US government mandates that you can get your reports for free, once a year, from one and only one official website, annualcreditreport.com. That's it. Go there, pull your reports from all 3 bureaus, and save them as PDFs. This is your starting point. Step 2 is where you can get the fastest and most dramatic results. Hunt for errors. You would be shocked at how many credit reports contain mistakes. A study by the Federal Trade Commission found that 1 in 5 consumers had an error on at least one of their credit reports. Think about that. There is a 20% chance that you are being penalized right now for something that isn't even your fault. You're going to go through each report line by line like a detective. Are all the accounts listed actually yours? Is there a late payment reported for a month you know you paid on time? Is there a collection account from a 5-year-old cable bill you already paid off? I once helped a friend do this, and we found a medical collection for $2,000 under his name. The problem? He'd never even been to that hospital. It was a simple clerical error, a case of mistaken identity, but to the insurance company's algorithm, he looked like a high-risk individual with unpaid medical debt. We filed a dispute online through the credit bureau's website, provided the evidence, and within 30 days, that negative mark was completely erased. The next time he shopped for insurance, his quotes were nearly 40% lower. That 1 hour of work saved him hundreds and hundreds of dollars a year. This is the single biggest opportunity for a quick win. Don't skip it. Step 3 is about mastering the most important factor of all, your payment history. This one accounts for about 35% of your credit score. Insurers see a history of late payments as a giant red flag. The fix is simple, but it requires discipline. Automate everything. I mean everything. Your credit card bills, your student loan, your car payment, your utility bills, your cell phone bill. Set up automatic payments for at least the minimum amount due for every single recurring bill you have. This creates a digital safety net. Even if you forget, the system won't. A perfect, uninterrupted record of on-time payments is the bedrock of a great score. It tells insurers that you are reliable and consistent, exactly the kind of customer they want. Step 4 is the secret weapon of people with amazing credit scores. Managing your credit utilization ratio. This sounds complicated, but it's incredibly simple. It's the percentage of your available credit that you are currently using. If you have one credit card with a $10,000 limit, and you have a $3,000 balance, your utilization is 30%. This factor makes up another 30% of your score, so it's hugely important. The golden rule is to always keep your overall utilization below 30%. Below 10% is even better. But here is the pro-level hack that most people don't know. Your credit card company typically only reports your balance to the credit bureaus once a month, on your statement closing date. This means that even if you pay your bill in full every month by the due date, you could still show a high utilization. Let's say you use your card for all your monthly expenses, and your balance gets up to $4,000 on a $5,000 limit. That's an 80% utilization. Even if you pay it all off on the due date, the credit bureaus might have already taken that 80% snapshot for the month, crushing your score. The solution? Pay your balance down or pay it off completely, a few days before your statement closing date. You can find this date on your monthly statement. By doing this, you ensure that the balance that gets reported to the credit bureaus is tiny or even zero. Your score will skyrocket, and insurance companies will see you as an exceptionally low-risk client. Step 5 is to protect the age of your credit history. This makes up about 15% of your score. The longer your history of responsibly managing credit, the better. This is why the common advice to close old and used credit cards is often terrible advice. Your oldest account acts as an anchor for your credit history. If your oldest card is 10 years old, and you close it, your new oldest card might only be 3 years old. You just artificially aged yourself down by 7 years in the eyes of the credit bureaus. It's like tearing out the first chapter of your financial biography. Unless that old card has a massive annual fee that you can't get waived, just keep it open. Put a small, recurring charge on it like a Netflix subscription, and set up an automatic payment. This keeps the account active and preserves your valuable credit history. So let's put it all together. You pull your reports. You find and dispute an error. You set up automatic payments for all your bills. You start paying your credit card balance before the statement closing date to keep your utilization near zero. And you protect your oldest accounts. If you do these things consistently for just 6 months, the change in your credit-based insurance score can be monumental. A person who goes from a poor credit category to a good credit category can see their car insurance premium drop by 50% or more, without changing anything else. We're talking about a potential savings of over $1,000 a year for some people. It is, without a doubt, one of the most effective, yet most overlooked ways to get cheaper car insurance. Now that you've laid the groundwork, you've cleaned up your driving record, you've optimized your credit score, you've become the ideal customer that every insurance company wants. It's time to make them fight for your business. But your current insurer isn't just going to call you up and offer you their best possible rate out of the goodness of their heart. You have to be proactive. You have to shop around. But the way 99% of people shop for insurance is completely wrong, and it leaves an incredible amount of money on the table. In the next part, I'm going to reveal the professional strategy for comparison shopping that forces companies into a bidding war and guarantees you find the absolute lowest price for the coverage you need. So how do you do it? How do you orchestrate this bidding war and make the insurance giants fight for your business? It's a strategy one call the quote gauntlet, and it transforms you from a passive price taker into an active, empowered buyer who dictates the terms. Most people do this all wrong. They get their renewal notice, see the price hike, and maybe, just maybe, they go to one or two big name websites, plug in their info, and get a couple of quotes. They pick the cheaper of the two and call it a day. This is exactly what the insurance industry wants you to do. It's lazy, it's ineffective, and it leaves hundreds, if not thousands, of dollars on the table. When you do that, you're signaling to them that you're not a serious shopper. You're just kicking the tires. The quote gauntlet is the opposite. It's a systematic, three-pronged attack designed to uncover every possible offer and then leverage those offers against each other. But before you can run the gauntlet, you have to prepare for battle. The single biggest mistake people make when shopping for insurance is using inconsistent information. They'll estimate their mileage on one site, use a slightly different job title on another, and forget to add a defensive driving course on a third. The result? A confusing mess of quotes that aren't comparable. You're comparing apples to oranges to, I don't know, car batteries. It's useless. To prevent this, you need to create what I call a master quote sheet. This can be a simple spreadsheet or even just a piece of paper. On this sheet, you will write down every single piece of data you will use for your quotes, and you will use this exact data without deviation every single time. This includes your full name, address, date of birth, and driver's license number for every driver in your household, the vehicle identification number, or VIN, for every car, the exact year, make, and model, the precise odometer reading, the estimated annual mileage for each vehicle. Be realistic here. Your current occupation, and most importantly, the exact coverage levels you want. Don't just say full coverage. That means nothing. Write it down. Bodily injury liability, $100,000 per person, $300,000 per accident. Property damage liability, $100,000. Uninsured/underinsured motorist. Match my liability limits. Collision deductible, $500. Comprehensive deductible, $500. Do you want rental reimbursement? Do you want roadside assistance? Decide on this one time and write it down on your master sheet. This document is now your Bible. Every quote you get will be for this exact package. This is the only way to ensure you're getting a true apples-to-apples comparison of price. Now that you're prepared, it's time to run the gauntlet. This is the three-pronged attack. Prong number one is the direct assault. This means going directly to the captive agents. These are the big household names that only sell their own insurance products. Think State Farm, Allstate, and Farmers. You either call a local agent or go to their corporate website. The goal here is to get a baseline quote from the titans of the industry. The advantage is that these agents know their company's policies and discounts inside and out. The disadvantage is that if their price isn't competitive, they have nothing else to offer you. They can't pivot and say, well, let me check with this other company. Their only tool is their own product. Get your quotes from at least two of these major captive insurers and log the results meticulously on your master quote sheet. Prong number two is the independent offensive. This is, without a doubt, the most powerful and underutilized weapon in the consumer's arsenal. You need to contact an independent insurance agent or broker. Unlike a captive agent who works for one company, an independent agent works for you. They represent dozens of different insurance companies, including many excellent, highly rated regional carriers you've probably never even heard of. Think companies like Erie Insurance, Auto Owners, or The Hartford. These companies don't spend billions on advertising with cartoon geckos or goofy generals. They spend it on competitive pricing and good service, and they rely on independent agents to find customers. When you talk to an independent agent, you are essentially outsourcing your shopping to a professional for free. You give them your master quote sheet information once, and they will run it through their entire network of carriers to find the best possible fit and price. This single step can uncover hidden gems and prices that are simply not available to the general public through a website. It multiplies your shopping power exponentially. Find a well-reviewed local independent agent and let them do the heavy lifting. This is how you find the deals the mainstream doesn't know exist. Prong number three is the digital blitz. This is where you leverage the power and speed of the internet, but you do it strategically. First, you hit the major online comparison sites. You know their names. These aggregators are great for getting a wide range of quotes quickly. They'll pull prices from a variety of carriers, giving you a broad overview of the market in minutes. But do not stop there. Not all companies play ball with these aggregators. Two of the biggest online first insurers, Geico and Progressive, often save their best rates for customers who come directly to their own websites. So after you use an aggregator, you must go directly to the Geico and Progressive sites and run your numbers again, using your master quote sheet to ensure consistency. This combination of aggregators and direct-to-consumer sites ensures you've covered the entire digital landscape. Log every single one of these quotes. By the end of this process, which might take you a couple of hours, your master quote sheet will be filled with data. You'll have quotes from captive agents, a range of quotes from an independent agent, and a blitz of quotes from online sources. You will likely have anywhere from 10 to 20 different directly comparable quotes. You now have more information about your personal insurance market than 99% of consumers. You can clearly see the outliers, the average, and most importantly, the clear winner on price. But we're still not done. This is where you trigger the final phase of the bidding war. You take the single lowest legitimate quote you received. Let's say it was from a company called Acme Insurance for $900 a year. Now you make a few phone calls. First, you call your current insurance company. You say, "Hi, my policy is up for renewal. I've been doing some shopping, and I have a written quote from Acme Insurance for the exact same coverage I have with you now, but it's for $900 a year. I've been a loyal customer for X years, and I'd really prefer to stay, but a savings of calculate the difference is hard to ignore. Is there anything at all you can do to match or get closer to that price?" Then, you hang up and do the same thing with your second and third lowest bidders. Maybe that was the quote from the State Farm agent or a specific company your independent agent found. You call them and use the same script. You are now negotiating from a position of ultimate power. You're not just asking for a discount. You are presenting them with hard evidence of the market price for your business. You have a real, committable offer from a competitor. This forces their hand. Many times, a manager can approve a competitor match discount, or they'll rerun your profile and magically find a discount you didn't qualify for an hour ago. You are no longer just another number in their system. You are a valued customer who is about to walk, and they will often fight to keep you. By making the companies compete with a real number, you squeeze every last drop of savings out of the process and guarantee you are getting the absolute rock-bottom price for your business. Now that you have a competitor's quote in hand, you're in the ultimate position of power. But this brings us to our sixth and arguably one of the most impactful strategies, meticulously right-sizing your coverage. Because getting a lower price on the wrong insurance is like getting a great deal on a winter coat in the middle of a Miami summer. It's useless. The single biggest mistake people make is they set their insurance policy once when their car is new and shiny, and then they never look at it again. They keep paying for a premium level of protection on a car that's depreciated by 70 or 80%. Let me tell you about a guy I know, let's call him Frank. Frank was a loyal customer to his insurance company for over a decade. He drove a 2008 Toyota Camry. Reliable car, but it had seen better days. It had a few dings, the paint was faded, and Kelley Blue Book valued it at maybe, on a good day, $3,000. Frank was paying his insurance bill every 6 months without a thought. One day we sat down and actually looked at his policy declaration page, and the numbers were staggering. He was paying for full collision and comprehensive coverage, and that portion of his bill was almost $900 a year. Let that sink in. He was paying 30% of his car's total value, every single year, for the privilege of being able to fix it in an accident. If he got into a wreck and totaled the car, the most the insurance company would ever pay him was $3,000, minus his $500 deductible. So a max payout of $2,500. After just 3 years of paying for that coverage, he had already paid the insurance company more than they would ever pay him back. He was lighting money on fire. This is where you need to get ruthless with your own policy. There are two key coverages you need to scrutinize: collision and comprehensive. Collision covers damage to your car if you hit another car or an object, like a pole or a guardrail. It's for when you are at fault. Comprehensive covers damage from almost everything else: theft, vandalism, fire, hail, a tree branch falling on your roof. These are wonderful to have on a new car, but they become a financial trap on an older one. So here is the golden rule, the simple calculation you need to do right now. It's called the 10% rule. If the annual cost of your collision and comprehensive coverage is more than 10% of your car's current cash value, you should seriously consider dropping them. Here's how you do it. First, go to a site like Kelley Blue Book or Edmunds and get a realistic private party value for your car. Be honest about the condition. Let's say it's worth $4,000. 10% of that is $400. Now, look at your insurance policy. It will break down the cost for each coverage. Find the line items for collision and comprehensive. Add up what you're paying for those two coverages over a full year. If that number is more than $400, you've hit the red zone. You are likely paying more for the insurance than the potential benefit is worth. Dropping this coverage feels scary to some people, but I want you to reframe it. You're not becoming uninsured. You are choosing to self-insure. You take that $400, $500, or $900 a year that you were giving to the insurance company and you put it directly into your own high-yield savings account. Call it your car repair and replacement fund. After a few years of safe driving, you'll have saved up a couple $1,000s. That money is now yours. You can use it to cover a major repair or as a down payment on your next car. You've taken back control from the insurance company. Now, for those with newer cars where dropping coverage isn't an option, there's another powerful lever to pull: your deductible. The deductible is the amount you have to pay out of pocket before the insurance company pays a dime. Most people default to a low deductible like $250 or $500 because it feels safer. But this safety comes at a massive cost, baked into your premium every single month. Think of it from the insurer's perspective. With a $500 deductible, they are on the hook for every little fender bender, every parking lot scrape that costs more than $500 to fix. That's a lot of potential small claims. But if you raise your deductible to $1,000, you are telling the insurance company, "Don't worry about the small stuff. I'll handle it. I will only call you if something really bad happens." This single move signals to them that you are a lower risk, and they will reward you for it big time. Raising your deductible from $500 to $1,000 can slash the collision and comprehensive part of your premium by 15 to 30%, sometimes even more. That could be hundreds of dollars in savings each year. The key is to make sure you actually have that $1,000 saved in your emergency fund. If you do, it's a no-brainer. You are making a calculated bet on your own good driving, and in the long run, the vast majority of drivers win that bet. This leads us directly to our seventh and final core strategy, and it's the one most people don't know about, or they don't believe how much it truly matters. It's leveraging your financial health. Because what if I told you that in many states, your credit score can have a bigger impact on your car insurance rate than a speeding ticket? It sounds crazy, but it's true. Insurance companies have spent billions of dollars analyzing decades of data, and they found a direct, undeniable statistical correlation. People with higher credit scores file fewer and less expensive claims. They're not judging you as a person. They're playing a numbers game. To them, a person who pays their bills on time and manages their debt responsibly is also more likely to be a responsible person in other areas of their life. They're more likely to get their oil changed on time, replace their bald tires, and drive cautiously. A good credit score is, in their eyes, a proxy for responsibility, and they price your policy accordingly. The difference isn't small. Moving from a poor credit tier to a good credit tier can cut your insurance premium in half. We're not talking about a 5% discount. We're talking about a potential savings of over $1,000 a year, year after year. It is one of the single most powerful long-term ways to secure cheap auto insurance for life. So your mission, if you choose to accept it, is to become a guardian of your credit. The first step is to see where you stand. Don't go to those weird free credit score websites that try to sell you things. Go to the one official, federally authorized source, annualcreditreport.com. There you can pull your full credit report from all three major bureaus, Equifax, Experian, and TransUnion, for free once a year. Once you have your reports, comb through them like a detective. Look for errors. A shocking number of reports contain mistakes, a late payment that was actually on time, an account that isn't yours. A single error can be an anchor dragging your score down. If you find one, dispute it immediately with the credit bureau. They are legally required to investigate. Getting an error removed is the fastest way to see a significant jump in your score. Beyond fixing errors, building great credit boils down to three simple, non-negotiable habits. First, pay every single bill on time every time. Your payment history is the single biggest factor in your score. Set up autopay for everything you can. Second, keep your credit card balances low. This is called your credit utilization ratio. If you have a card with a $10,000 limit, try to never let the balance go above $3,000, which is 30%. And if you can keep it below $1,000 or 10%, even better. It shows you're not reliant on debt. Third, don't apply for a bunch of new credit all at once. Each application creates a hard inquiry that can temporarily ding your score. Improving your credit isn't an overnight fix. but it's a foundational piece of your financial life that pays you back in countless ways, especially with insurance. Once you've spent a few months practicing these habits and you see your score start to climb, that is the signal. It's time to call your insurance agent, or better yet, start shopping for quotes all over again. You are now, in the eyes of the insurance industry, a brand new lower-risk customer, and you deserve a brand new lower price. By right-sizing your coverage for the car you actually drive today, and by actively managing your credit score, you're moving beyond simple discounts. You are fundamentally changing the way insurance companies see you, transforming from a generic bundle of risks into a premium, low-cost client they will fight to win over. And now we arrive at the final and arguably most powerful strategy of them all. This isn't just a tip. It's the master key that unlocks the true value of everything we've discussed so far. It's the single action that can save you more money than all the others combined, and it's the one that 90% of people get wrong, or worse, don't do at all. We're talking about the art and the science of shopping for your insurance. Now I know what you're thinking. Shop around? Yeah, I've heard that before. But I'm not talking about plugging your info into one website and calling it a day. I'm talking about a systematic, strategic assault on the high cost of insurance. I'm talking about turning the tables on the insurance industry and making them compete for your business, not the other way around. Let me tell you about a guy named David. David was the model customer for his insurance company, a big, friendly-sounding carrier we'll call Patriot National. For 14 years, David paid his premium on time every 6 months without fail. He never had an at-fault accident. He thought his loyalty meant something. He even had a loyalty discount listed right there on his policy statement. It was for a grand total of 5%. He felt taken care of. One day at a family barbecue, his cousin mentioned he just switched insurance and saved $800 a year. David scoffed. "My rate is good," he said. "I've been with Patriot National forever." His cousin just smiled and said, "Just for fun, spend 15 minutes and get one other quote." Annoyed but curious, David went home and did just that. He got a quote from another major carrier for the exact same coverage. The result? His jaw hit the floor. The new quote was over $1,000 a year cheaper. $1,000? David felt a wave of emotions. First shock, then anger. He felt betrayed. His 14 years of loyalty hadn't been rewarded. It had been punished. He was a victim of something the insurance industry counts on, but never talks about: the loyalty penalty. Here's the dirty little secret. Insurance companies are brilliant at acquiring new customers. They spend billions on ads with catchy jingles and funny mascots, and they offer deeply discounted introductory rates to get you in the door. But once you're in, they bank on inertia. They know you're busy. They know you hate paperwork. So year after year, they often creep your rate up in small increments, a practice sometimes called price optimization. They're not raising it because your risk has changed. They're raising it because their data shows you probably won't leave. That 5% loyalty discount they give you as a smokescreen to make you feel appreciated, while they quietly charge you 25% more than a new customer. Being a loyal, long-term customer can actually make you one of their most profitable clients, and not in a good way. So how do you fight back? You adopt the mindset of a free agent. You owe them nothing. Your goal is to get the best possible coverage for the lowest possible price, period. And you do this by creating a personal bidding war for your policy at least once a year. Here is the framework for how to do it like a pro. First, timing is everything. The most obvious time to shop is a month before your policy renews. But that's just the beginning. You should also be shopping anytime you have a major life event. Did you just get married? Shop for insurance. Your rates can drop significantly. Did you just buy a home? Bundle and shop. Did a ticket or an accident from 3 or 5 years ago just fall off your record? That's a huge trigger. Shop immediately. Did you just improve your credit score by 50 points using the strategies we talked about earlier? That's your cue to shop. Think of these life events as rate reset moments. Second, you need to prepare your arsenal. The biggest reason people don't shop is because it feels like a hassle. So eliminate the hassle. Create a folder on your computer or a physical folder at home. In it, you will keep 3 things. 1. A PDF of your current policy's declarations page. This is the holy grail. It lists all your coverages, your vehicles, your drivers, and your VIN numbers. It's everything you need for an apples-to-apples comparison. 2. A simple document with the full names, dates of birth, and driver's license numbers for every driver in your household. 3. A rough estimate of the annual mileage for each vehicle. That's it. With these 3 things, you can get a quote from any company in under 10 minutes. Now for the main event, the 3-pronged attack. You never rely on a single source for quotes. You hit the market from 3 different angles to ensure you see the whole picture. Prong 1 is the aggregators. These are the online comparison websites like the Zebra, Insurify, or Gabi. They are a fantastic starting point. You enter your information once, and they pull quotes from a dozen or more different insurers. This gives you a quick, wide-angle view of the market and establishes a baseline price. But, and this is critical, do not stop here. Many of the biggest and sometimes cheapest companies like Geico don't participate in these sites. The aggregators are just your first reconnaissance mission. Prong 2 is the direct approach. After you've used an aggregator, you're going to go directly to the websites of at least 2 major carriers who weren't on that list. Pick a couple of the big names you see on TV all the time. Because they don't have to pay a commission to the comparison site, their direct prices can sometimes be even lower. You're cross-referencing and leaving no stone unturned. Prong 3 is your secret weapon. The independent agent. This is the one most people skip, and it's a massive mistake. A captive agent, like one from State Farm or Allstate, can only sell you policies from their one company. But an independent agent is a broker. They work for you, not the insurance company. They have contracts with dozens of different carriers, including smaller, regional companies you've never even heard of that might have incredibly competitive rates for someone with your exact profile. They do the shopping for you for free. They can explain the nuances between policies and find obscure discounts you'd never discover on your own. A good independent agent is like having a professional negotiator on your team. Simply search for independent insurance agent in your town. Call one up. It will be the most valuable 20-minute phone call you make all year. Once you've completed your 3-pronged attack, you will have a clear winner. A quote that is significantly cheaper than your current rate. But you're still not done. Your final move is the loyalty gambit. You call your current insurance company. You don't yell, you don't complain. You are calm, polite, and professional. You say this: "Hello, my name is," your name, "and my policy number is," your number. "My renewal is coming up, and as part of my annual financial review, I've been getting some other quotes. I've been a loyal customer with you for X years and I'd really prefer to stay. However, I have a quote from competitor's name for the exact same coverage that is $$ lower. Is there anything you can do to match or get closer to that price so I can remain a customer?" And then you are silent. Let them work. You have just turned the tables completely. You've demonstrated you're a savvy consumer, you've given them a specific target to hit, and you've expressed a desire to stay, giving them an incentive to keep you. Sometimes a magical, previously unavailable retention discount will suddenly appear. If they can match the price, you've saved money without the hassle of switching. If they can't, you thank them for their time, hang up, and switch to your new carrier with the absolute confidence that you are not leaving a single dollar on the table. This is how you take control. We've journeyed through 7 core strategies. We moved from simple tweaks like adjusting your deductible to fundamentally changing your risk profile with defensive driving and telematics. We learned to surgically optimize our coverage like a professional and to build a credit score that makes insurers see us as a premium client. And now we've tied it all together with a professional-grade shopping strategy that ensures we are always paying the absolute lowest market rate for our policy. Car insurance is not a fixed expense like your rent or your mortgage. It is a dynamic, negotiable price that you have immense power to influence. The single biggest financial mistake you can make with car insurance is complacency. It's assuming you're getting a good deal just because you've been with a company for a long time. So I'm asking you to do one thing. Not tomorrow, not next week. Right now. Find your latest car insurance bill or declarations page. Look at the renewal date. Go to your phone and set a calendar alert for 30 days before that date. Title the alert, "Shop My Car Insurance." And when that alert goes off, commit just 60 minutes to executing the 3-pronged attack we just outlined. That 1 hour of your time could easily save you $500, $1,000, or even more. There is no other hour in your year that will have a higher return on investment. You are not just a customer. You are the CEO of your own finances, and you have the power to stop overpaying and start putting that money back where it belongs. In your pocket, building your future.